So in this session, we'll be looking at the last week on consolidations after acquisition. Okay, can you guys have confirmed that you can see the slides? Okay. Okay, so let's have a look. So far you had an introduction into consoles and you had a look at how to account for an acquisition at acquisition, meaning you looked at the pro forma journal entries where you eliminated the equity of the subsidiary against the investment of the subsidiary. And you saw where you had a situation where goodwill could result or a gain on bargain purchase could result. Then after that, you had a look at something called non-controlling interest. So non-controlling interest is where the subsidiary is not wholly owned. Sometimes there will be a small percentage, about 10 or 20%, that is owned by other minority investors. And this is known as non-controlling interest. So this week we're going to look at after acquisition and how to deal with a situation where we have non-controlling interest. And often in the examples you've seen previously, you've seen situations where the company was bought during the current year. But now we're going to look at situations where the company was bought in the prior year and how we account for this consolidation. Okay, can you guys see the slide or do I need to zoom in? Okay, so this is just saying it is the last lecture. So just to mention that the consolidation procedures remain the same. So remember we had various steps to follow. So just to recap, step one was to eliminate the investment in the subsidiary against the equity of the subsidiary. Then after that, we had a look at common or intergroup items. These items are also going to be eliminated. So an example of these items would be where the parent makes a loan to the subsidiary and you have a loan from the parent to the subsidiary or vice versa. When you, in the separate financial statements, that's okay. But when you're preparing a consolidated set of financial statements, you're basically viewing the parent and the subsidiary as one company. So when we have one company, you cannot have a loan to itself. So there were various items or intragroup transactions or balances that needed to be eliminated. And we had a look at that as well in one of the previous lectures. Then once you have done step one and step two, you need to go to step three. So step three was where we will consolidate remaining non-common items. So the statement of profit or loss and OCI. So the statement of profit or loss and OCI will also need to be prepared, and the statement of financial position. So we will take our assets of the subsidiary and we will add it to the parent company's assets. So we will basically prepare line by line, also taking into account the pro forma journal entries prepared. Okay, so we will recap that, but that is just to briefly discuss the steps. So if we have a look at the next slide, so where a subsidiary was purchased prior to the current reporting period, we need to analyze the subsidiary's closing retained earnings, okay? So we will have this balance of retained earnings, and we will need to break down the figure, and we will need to assess what portion of this closing balance on retained earnings is pre-acquisition profits, and what portion is post-acquisition profits. So what is pre-acquisition profits? This is basically the retained earnings of the subsidiary at acquisition. So the pre-acquisition profits, this is what is eliminated when we do our pro forma journal entries. But because we have a situation here where a subsidiary was purchased prior to the current reporting period, we are often given a closing balance of retained earnings, and we now need to split this into the pre-acquisition profits and the post-acquisition profits. So the post-acquisition profits, these are the profits that are made after the subsidiary was acquired. Okay. So keep that in mind as we go on, and we will do a few examples in this lecture to help you understand that. So the post-acquisition profit, so remember we said the closing balance needs to be split between pre-acquisition profits and post-acquisition profits. Once we have determined what our post-acquisition profits are, we need to further analyze our post-acquisition profits into the portion of profit that was made from acquisition date to the beginning of the current year, and that portion of post-acquisition profits for the current year. So remember, when we prepare financial statements, we're preparing the financial statements for 1 year. But our retained earnings is actually the accumulated profits from all of the prior years, which is why it is necessary to now split that closing balance of retained earnings into our pre-acquisition and post-acquisition, and then we'll take our post-acquisition profits and further split it between the post-acquisition profits for the current year and the post-acquisition profits from the date the subsidiary was acquired to the beginning of the current year. Okay, so it sounds confusing, like we're going to be analyzing retained earnings forever, but once you know the steps, it actually becomes quite simple. Okay, there's a few steps we're going to go through in order to do that. Okay, I am zooming into the slides, so hopefully you can all see them. So both the categories of post-acquisition profits must then further be analyzed into the post-acquisition profits that are attributable to the parent and the post-acquisition profits that are attributable to the NCI, also known as non-controlling interest. So when we analyze these post-acquisition profits, we are going to be looking at the subsidiaries' profits, which is basically 100% of their profits. But now remember, when a company is not wholly owned, the profits of the subsidiary do not belong all to the parent. A portion of the profits belong to the minority shareholders, being the non-controlling interest. So after we have done our analysis of our pre-acquisition profits and our post-acquisition profits for the current year and our post-acquisition profits from acquisition date to the beginning of the current year, we now need to see what portion of this profit is attributable to the parent and what portion is attributable to the non-controlling interest. Okay, and one of the tools we use to help us is our analysis of equity. So we will have a look at that, and that will hopefully assist to help us do this analysis. So we have an example here on slide 7. So here we have a picture of a group of companies. So we have the P group, and we have P Pty Limited, the company, and we have S Pty Limited, the subsidiary. Okay, so just to show you an example of all of the retained earning items we're going to analyze here. So in this example here, the closing balance of retained earnings for the parent company was 70,000, and the closing balance of retained earnings for the subsidiary was 24,000. Now we have said that this closing balance of retained earnings, it needs to be analyzed further, because in here are the pre-acquisition profits and the post-acquisition profits. So in the individual company of S Pty Limited, there's this closing balance amount of 24,000 Rand. But this relates to the profits that were generated before this company was acquired, and some of it will relate to profits that are generated after it was acquired by Pty Limited. So just as an example to show you here, here if the closing balance is 24,000 Rand, this can be analyzed, for example, into 4,000 Rand. If the question told us that 4,000 Rand was earned before it was acquired, this is going to be known as the pre-acquisition profits. And then if the question told us after S was acquired, it had 20,000 Rand of profits, this is known as the post-acquisition profits here. Okay, so when we think of retained earnings, you must think of it as accumulated profits. So retained earnings can also be described as accumulated profits. These are profits that have been accumulated over the existence of the entity. Therefore, the retained earnings of a subsidiary are generally made up of profits generated before acquisition, known as pre-acquisition profits, as well as post-acquisition profits, which are the profits that are made after it is acquired. Okay, so there's a question, do we only take 20,000 into consideration? Okay, so remember this pre-acquisition retained earnings amount of 4,000 Rand. This is the amount that would be eliminated. So you can't ignore it altogether. It will be taken into account when you're looking at your pro forma journal entries. But when you are looking at the profits of the group, you obviously can't include the amount of the 4,000 Rand because this was made before the subsidiary was purchased by the parent. So essentially that pre-acquisition profit of 4,000 Rand, it will form part of your pro forma journal entries and will be eliminated on acquisition. And then that 20,000 Rand will need to be further analyzed into that portion that was earned in the current year and that portion that was earned from acquisition date to the beginning of the current year. And then obviously we need to then split out the post-acquisition profit, what is attributable to the parent and what is attributable to the non-controlling interest. Okay, but let's have a look at the next slide. We have a few examples to help us do this exercise. Okay. Okay, so I've kind of covered this already, but I'll just repeat it. So pre-acquisition profits, these are profits that are earned by the subsidiary before the parent obtained control of the subsidiary. That is why they are called pre-acquisition profits. So therefore, they do not form part of the profits that are attributable to the group, okay? They are referred to as purchase profits, and they form part of the equity of a subsidiary that is eliminated on acquisition. So this is exactly what I've said. The pre-acquisition profits, these were earned before the subsidiary was purchased by the parent. Therefore, this will be eliminated on acquisition. And then the post-acquisition profits, these are profits that will need to be split between the parent and the NCI and between the current year and the period from acquisition date to the beginning of the current year. So because the parent company was not involved in generating the pre-acquisition profits, it didn't have control before it acquired the subsidiary. Therefore, the pre-acquisition profits should not be included in the group profits. The pre-acquisition profits will be eliminated and will not be included in the group profits. Okay, so let's carry on now. So this is just to recap the elimination of the common intergroup items, okay? So these are the pro forma journal entries we'll record on acquisition. This is just to recap the other weeks. So when you perform your pro forma journal entries, we will go debit share capital of the subsidiary and debit retained earnings pre-acquisition profits of the subsidiary. Then we will debit any other reserve or equity that the subsidiary has on acquisition. We will obviously set the equity off against the investment in the subsidiary, and then we Okay, so these are the pro forma journal entries. You should all be familiar with that now because they have featured in almost every lecture on consolidations. Okay, apparently I cut, so let me just repeat this quick. So these are the pro forma journal entries that we perform. So here we have debit share capital and we have debit retained earnings. Remember, these retained earnings that we are eliminating are the pre-acquisition profits of the subsidiary. Okay, if I lose internet connection, you must just wait for me and I'll try to reconnect. Hoping my internet will be stable for the rest of the lecture though. So the pro forma journal entries will eliminate the equity of the subsidiary, which is represented by the share capital and the retained earnings, specifically the pre-acquisition profits in the retained earnings. If the subsidiary has any other equity, we will also debit that, which will essentially eliminate the equity of the subsidiary, and we'll credit the investment in the subsidiary. So we're essentially setting off the equity in the subsidiary against the investment in the subsidiary. The investment in the subsidiary represents the consideration paid. So once we have determined that, we're basically comparing the amount paid by the parent to the equity that it is acquiring, and that will determine the goodwill or the gain on bargain purchased. We obviously need to also know the non-controlling interest and its impact in this transaction. When a parent company does not own the subsidiary, it is not wholly owned, it doesn't own all of it, then we have something called non-controlling interest. Okay, and that needs to be taken into account. Let's have a look at the next slide. So here we have a little group structure just to illustrate what we'll be doing. So in this group here, we have the P group, and the parent is P Pty Limited. And for example, if they have a closing balance of retained earnings of 70,000 here, then we have S Pty Limited. This is the subsidiary. They have a closing balance of retained earnings of 24,000 Rand. And in this example, the subsidiary was acquired about 2 years ago. Okay, so this retained earnings closing balance of SPTY Limited, every year the company SPTY Limited would have made a profit. And at the end of the year, the previous year profit goes into our retained earnings. So essentially our retained earnings is the accumulated profits. Okay, the retained earnings Okay, can you guys hear me now? It seems to have come right. Okay, can you guys hear me? I don't know what's going on. It's so annoying. I've connected to my hotspot on my phone because my internet was giving me a problem earlier. Let's hope it stands. Okay, so in this example here, we have a company called P. We have a group called P Group. Okay, so the parent company is P Pty Limited, and they have a closing balance of 70,000 Rand. Then we have a subsidiary of SPTY Limited. They have a closing balance of retained earnings of 24,000 Rand. So in this example, P acquired SPTY Limited about 2 years ago. So we have then to split the retained earnings. So this retained earnings is 24,000 Rand, and it basically consists of all of the accumulated profits from the previous year. So we now need to split this closing balance of retained earnings of 24,000 Rand. We need to split it into our pre-acquisition retained earnings and our post-acquisition retained earnings. So what is our pre-acquisition retained earnings? Our pre-acquisition retained earnings is basically the profit that the company made before it was acquired. So before S was acquired by P, it would have operated and made a profit, and this would have been accumulated in its retained earnings. So this 4,000 Rand is known as the pre-acquisition profit or pre-acquisition retained earnings. And this is the amount that will be eliminated when P acquires S. So this is known as the retained earnings like on acquisition, and this will be eliminated in the pro forma journal entries in the group. Okay. Then we have post-acquisition profits. So a portion of this closing balance of retained earnings is 20,000 Rand. And this consists of profit that was made after acquisition up until today's date. So once it was acquired, the subsidiary would have operated and made profits, and this would have been accumulated in the retained earnings. So in this example, it's 20,000. But now remember, if the subsidiary was bought, say, 2 years ago, this post-acquisition profit would be 2 years worth of profits, okay? So we now need to split this into the current year profit and that portion of retained earnings that was made after acquisition up until the current date. Okay, so we are now splitting this 20, for example, post-acquisition profits. Let me just see my internet connection on my phone quick and see if I can improve it. Okay, let me just see what I can do quickly. Hey, can you guys hear me now? Sorry, I don't know why it keeps cutting. It's very annoying. Okay. Okay, you guys can hear me. I did lose connection there for a while. Let's see if it continues. Let me change to my Wi-Fi and see if that's working now. Okay. Okay, can you guys hear me now? Okay, I'm so sorry, guys. You know, often these things are out of your control. Okay, so let's start now from the closing balance of retained earnings being 24,000 Rand. this is going to be split into pre-acquisition profits and post-acquisition profits. Now, when we look at the post-acquisition profits, if the subsidiary was bought 2 years ago, this is going to consist of 2 years worth of accumulated profits. Okay, so now we need to split this 20,000 Rand into that profit that is from the current year and that profit that was from acquisition date to the beginning of the current year. Okay, because often the subsidiary could be bought about 2 years ago or 3 years ago, and the closing balance of the retained earnings will include every year's profits. So once we have split out the pre-acquisition profits, which will form the amount that is going to be eliminated on the pro forma journal entries, we'll be left with the post-acquisition profits. And this will consist of the profits from acquisition date to the end of the current year. So that could be 2 years, it could be 3 years, it could be longer. So we now need to ask ourselves, what is the amount in this post-acquisition profit that is for the current year, meaning like the last 12 months, and what portion relates to other prior years after acquisition? Okay, it sounds confusing, but once we do an example, we'll understand it better. So these amounts are just fictitious amounts, okay? We haven't got a scenario here. It's just to help you understand what our aim is. So our aim for our post-acquisition profits is to calculate our current year profits and that amount which relates to the profits from acquisition date to the beginning of the current year. Okay, so let's go to the next slide. So here this just explains the slide which I have explained already, but I'll just explain it again. So basically the post-acquisition profits, these are profits that are earned by the subsidiary after the parent has obtained control of the subsidiary. So it's from acquisition date. So these post-acquisition profits, they are considered as distributable profits from the point of view of the group. So the post-acquisition profits are not available for distribution by the parent until they are distributed by the subsidiary as dividends. Okay, so that's just the extra point there. So the dividends, the profits of the subsidiary need to be distributed by the subsidiary. They can't just be distributed by the parent. Okay. Then if we look at the next slide, so the post-acquisition profits that are part of the opening balance of retained earnings for the period in which the consolidation takes place, these need to be separated from the pre-acquisition profits included in the subsidiary's opening balance of retained earnings. Okay, so that just says that the post-acquisition profits, this could be profits for a few years because perhaps acquisition took place 2 years ago. So if our acquisition took place a few years ago, meaning it was acquired 4 years ago, the post-acquisition profits will consist of 4 years or 2 years or however long the acquisition took place. So this post-acquisition profit then needs to be split into that which relates to the current year and that which relates to prior years after acquisition. So these post-acquisition profits of the subsidiary must be included in the group's opening balance of retained earnings in the statement of changes in equity and statement of financial position. So the post-acquisition profits, these are going to be included in the group. So remember we said the pre-acquisition profits are eliminated. So then you might ask yourself, what happens to the post-acquisition profits? These are going to be included in the opening balance of the retained earnings in the consolidated statement of changes in equity and statement of financial position. Okay, let's go to the next slide. We should be getting to some examples soon, and this will help us understand all of these words. Okay. So in our lecture example 1 here, it says Pty Limited bought 100% of the equity of SPty Limited on the 1st of January 2010. Pty Limited's opening balance of retained earnings on the 1st of January 2013 is 500,000, and Pty Limited's opening balance of retained earnings on the 1st of January 2013 is 180,000 Rand. So if Pty Limited's retained earnings at acquisition was 40,000 Rand, what will the opening balance in the retained earnings column of the consolidated statement of changes in equity be for 31 December 2013? So this sounds very confusing. Okay, can anyone say how we're going to go about this? Okay, so they've given us all of this information, and we now need to determine what is the opening balance in the retained earnings column of the consolidated statement of changes in equity for the year ended 31 December 2013. So how are we going to calculate this? So we need to determine what is the post-acquisition retained earnings. So how do we determine the post-acquisition retained earnings? So they told us there that the subsidiary's retained earnings at acquisition was 40,000 Rand, okay? So this amount is obviously going to be eliminated, okay? Then we are told that in S's separate books, its retained earnings on the 1st of January is 180,000 Rand. So on the 1st of January 2013, we have an opening balance on retained earnings of 180,000 Rand. But if the retained earnings at acquisition was 40,000 Rand, meaning the retained earnings at acquisition of 40,000 Rand, this will be like eliminated, then surely the post-acquisition retained earnings are 180,000 Rand minus 40,000 Rand, and this will give us 140,000 Rand. So it says the opening balance in the retained earnings column, they're just giving you the information. They told you that the parent company has 500,000 Rand in retained earnings, but S's post-acquisition retained earnings can be calculated by taking 180,000 Rand, and this 180,000 Rand is represented by the opening balance of retained earnings on the 1st of January 2013. So this is in the subsidiary's separate books. So it is going to include all of its accumulated profits. But what portion of the accumulated profits in the retained earnings relates to the pre-acquisition amount? So they told us there that Pty Limited had retained earnings at acquisition of 40,000 Rand. So do you agree that the 40,000 Rand, this is the pre-acquisition retained earnings? This will be eliminated. So if the pre-acquisition retained earnings is 40,000 Rand and your total retained earnings is 180,000 Rand, then you know that the post-acquisition retained earnings is 140,000 Rand. So the question asks, what will the opening balance in the retained earnings column of the consolidated statement of changes in equity be for the end of 2013? So remember, we are essentially preparing the group's consolidated statements of changes in equity. So we're going P plus S. So we have determined that S's post-acquisition retained earnings is 140,000. So we are going to go P plus S, and P's retained earnings was 500,000 Rand. So this is going to give us a total opening balance in the retained earnings column in the consolidated statement of changes in equity of 640,000 Rand. Okay, so that is a simplified example, but we have some other examples that are a bit more complicated. But this is just to illustrate the point. But let's just go through the new step we have created now. So remember we had a look at the steps and we had a look at step 1 to 3. Now we need to add step 4. So step 1 is elimination of the investment in the subsidiary against the equity of the subsidiary. So here we are going to eliminate, we're going to do that elimination of equity in subsidiary, its share capital, its retained earnings, any reserve, and we're going to eliminate that against the investment amount. We'll see if there's any goodwill or gain on bargain purchase, okay? And we're obviously also going to see if there's any non-controlling interest. Step 2, we have an elimination of our common intragroup items. This is the transaction, for example, where P made a loan to S. So in S's books, it has a loan amount showing. In P's books, it has the other side of the transaction. On consolidation, these amounts need to be eliminated because we're preparing the financial statements from the group perspective. Then once we have eliminated any intragroup transactions and balances, we need to consolidate the remaining non-common items line by line. So here, if the company has if P has PPE of 100,000 Rand and S has PPE of 50,000 Rand, you're simply going to go P plus S, and that will give you PPE of 150,000 Rand. So that is step 3. In step 3, you will prepare the statement of profit or loss and OCI and the statement of financial position. So step 4 now goes a step further and says, prepare the consolidated statement of changes in equity before or after consolidated statement of financial position. So here you'll be preparing the consolidated statement of changes in equity, okay? So we are going to look at that. Obviously, to do this, we need to analyze our retained earnings. So we have our opening balance and we have a closing balance, and we have all of those other items that are going to impact our retained earnings. Okay. So let's have a look at the next slide in lecture example 2. Okay, so this is a bigger example, so you'll have to just bear with me. Here we have a company P Pty Limited, and they bought 80% of the equity of S Pty Limited on the 1st of January 2011. Okay, so if P bought 80% of the equity of S, will we have non-controlling interest? So will we have non-controlling interest? If P bought 80% of the equity of S, will we see non-controlling interest in our group financial statements? Okay, yes, we will. Because there's another 20% that is held by minority investors, a portion of the profit earned by S needs to be attributable to those minority shareholders. So yes, we will have non-controlling interest. So P paid 720,000 Rand, and on acquisition, S has share capital of 500,000 Rand and retained earnings of 380,000 Rand. So this is on acquisition. So do you agree that this 380,000 Rand that S had on acquisition date, does this represent pre-acquisition or post-acquisition profits? So this 380,000 Rand, this is retained earnings on acquisition date. So this is going to show the pre-acquisition retained earnings. Okay, good. All the assets and liabilities of S were considered to be fairly valued at acquisition date. So P Pty Limited's closing balance of retained earnings on the 31st of December 2013 was 1.5 million, and S Pty Limited's closing balance of retained earnings on the 31st of December was 900,000 Rand. Okay, so this 900,000 Rand, this is the closing balance of retained earnings in S Pty Limited's individual books. So do you agree this 900,000 Rand, this is going to include the pre-acquisition profits and the post-acquisition profits? So this 900,000 Rand will have to split into pre-acquisition profits and post-acquisition profits. Okay, so just looking high level, can anyone tell me if they can calculate what the post-acquisition profits will be? What is the post-acquisition retained earnings or post-acquisition? Let's use the word retained earnings. What is the post-acquisition retained earnings of S? Okay, so the post-acquisition retained earnings can be calculated by taking the total closing balance of the retained earnings of 900,000 Rand and subtracting the pre-acquisition retained earnings of 380,000 Rand. So this will give us a post-acquisition retained earnings of 520,000 Rand. Now we know that the post-acquisition retained earnings, they include the profit for the current year, but also they include the profit for the period from acquisition date to the current period. Okay, so look here, the acquisition date was the 1st of January 2011, and we have the retained earning balance of 31 December 2013. So what is the current period in dates? Okay, from the 1st of January to the 31st of December 2013, do you agree that is the current year date? So 1st January 2013 to 31 December 2013, that is the current date, okay? This writing is very big. Okay, so that is the current date. Now, look at your acquisition date. Your acquisition date was 1st of January 2011. So now, from the 1st of January, let me just type this. Can you guys see my typing? From the 1st of January 2011, so that was the acquisition date. So from the 1st of January to the 31st of December 2012, this is the date from acquisition to the beginning of the current period. Okay, so what I'm trying to demonstrate here is that before acquisition, so before the 1st of January 2011, that retained earnings was 380,000 Rand. And we said that was the pre-acquisition retained earnings because it was just before acquisition. Okay. Then from the 1st of January, S was acquired by P. So from the 1st of January 2011 to 31 December 2013, this is our post-acquisition retained earnings. And you guys calculated that this was 520,000 Rand. Now that 520,000 Rand consists of 3 years worth of retained earnings. So it consists of the profit from 1st of January 2011 all the way, and it's accumulating the profit up until 31 December 2013. So do you agree that post-acquisition profit of 520,000 Rand, it includes like 3 years? So we now need to split that post-acquisition retained earnings of 520,000 Rand into the current date, being 1st of January, I think someone's moved it, 1st of January 2013 to 31 December 2013. This is the current date. And then we want to know what portion of the post-acquisition retained earnings relates to the period after acquisition to the beginning of the current year, which is 1st of January 2011 being the acquisition date to 31 December 2012 being the date just before the current year. So we now need to split that post-acquisition retained earnings of 520,000 Rand into the current year, and that portion that relates to the 1st of January 2011 to 31 December 2012. So who can tell me in the question here, what is the current year amount in our post-acquisition retained earnings? So remember, you told me that the post-acquisition retained earnings was 520,000 Rand. What is the retained earnings amount in there that relates to the current year? So they tell us in the question here that in the year ending 31 December 2013, P made a profit after tax of 400,000 Rand and they declared a dividend of 40,000. S made a net profit after tax of 220,000 Rand and declared dividends of 20,000. Okay, so the net profit after declaring dividends, so remember when a company declares dividends, it reduces the retained earnings amount. So what portion of the retained earnings in that 520,000 Rand relates to the current year? So what portion of the post-acquisition retained earnings of 520,000 Rand relates to the current year? So the current year retained earnings is 200,000, and this is calculated by taking the 220,000 profit minus the dividends of 20,000. Then if we have our current year profit, so we know our total post-acquisition profit is 520,000 Rand. The portion relating to the current year is 200,000 Rand. So now who can tell me what is the portion relating to the period 1st of January 2011 to 31 December 2012? What is the amount of the post-acquisition retained earnings relating to 1st of January 2011 to 31 December 2012? So we agreed that the total retained earnings relating to the current year is 200,000. Remember, we need to take out that dividend because that will reduce the company's retained earnings. Therefore, the amount of the post-acquisition retained earnings relating to 1st of January 2011 to 31 December 2012, this can be calculated by taking the 520 minusing the current year retained earnings of 200,000 Rand. So this will give us an amount of 320,000 Rand, being the post-acquisition profits from acquisition date to beginning of the current year. Okay, so this is what we've just calculated. Let's have a look at the diagram and see if our thinking is consistent with the diagram. So they told us Pty Limited's closing balance of retained earnings is 1.5 million. Then the subsidiary's closing balance of retained earnings is 900,000. And we agreed that this 900,000, this is the closing balance of the retained earnings in the subsidiary's individual books. So this is going to include all of the accumulated profits from the date it started operating right until the current year. So this amount consists of the pre-acquisition. So we want to know what portion of this 900,000 relates to that which was earned before acquisition by P and which is attributable to the period after acquisition. So they told us in the question that S had retained earnings on the 1st of January 2011 of 380,000 Rand. So we agreed that this 380,000 Rand, this is the pre-acquisition retained earnings. And this is going to be eliminated on acquisition by our pro forma journal entries. Okay. So this amount of 380,000, it relates to profits that were earned before acquisition. We cannot include it in our group because it is eliminated. Okay, it doesn't belong to us. Therefore, once we take our total retained earnings and we subtract the 380,000, this will give us 520,000. So that is how we get the 520,000 post-acquisition retained earnings, We're taking our closing balance of retained earnings being 900,000 and we're subtracting 380,000 Rand being the pre-acquisition retained earnings. This is going to give us 520,000 post-acquisition retained earnings. But now remember, this post-acquisition is from the date of the 1st of January 2011. So 1st of January 2011 to 31 December 2013. So do you agree this post-acquisition amount of 520,000, it consists of almost 3 years worth of profits. We now want to split this post-acquisition amount into the current year profits, or the retained earnings that relates to the current year, and that which is from 1st of January 2011 to the beginning of the current year. So they told us there that S made a profit of 220,000 and paid dividends of 20,000. So we know that the retained earnings relating to the current year is 220,000 minus 20 being the dividends. So the post-year acquisition profits relating to the current year is 200,000. Therefore, the post-acquisition profits relating to the period from acquisition to the beginning of the current year is 320,000 Rand. How did we get the 320,000 Rand? We took 520,000 being the post-acquisition retained earnings, and we stripped out the retained earnings relating to the current year, and that left us with 320,000 Rand. So this is the retained earnings from the 1st of January 2011 to 31 December 2012. Okay. So let us go look at an example. Do you have any questions on this? Okay, it's a simplified version in a diagram. You can draw a diagram in a question to assist you understand everything. Okay, we'll do our best to finish. I might have to go a bit faster. We will look at the analysis of equity to assist us. Okay, so to calculate, this is probably what I've said, to calculate the opening balance in the retained earnings column of the consolidated statement of changes in equity, we need to split S's opening balance between pre-acquisition profits and post-acquisition profits. That is what we did, okay? So we looked at our diagram and we said that a portion of this retained earnings relates to pre-acquisition profits and a portion relates to post-acquisition profits. So then we will look at our post-acquisition profits and we will split this between the portion that relates to the current year and the portion that relates to the date from acquisition to the beginning of the current year. So once we have done that, we then need to allocate the non-controlling interest their share of the post-acquisition profits. And what is the tool we use to assist us when we have non-controlling interest and we have all of these figures? We are going to look at the analysis of equity. Okay, this is going to assist us because it can be very difficult to understand the consolidation without this tool. Okay, so this is highly recommended for a test or exam. Sometimes we will ask you to prepare it, sometimes we won't, but it's always advisable to prepare it because it does assist with understanding. So let's have a look now. So here we were told in the scenario that the subsidiary S had share capital of 500,000 Rand on acquisition and retained earnings of 380,000 Rand. So we need to eliminate the portion that relates to P. So remember, P bought 80% of the equity. So P's portion of this equity that is purchasing is 500,000 times 80%. This will give us share capital relating to P of 400,000 and retained earnings relating to P of 304,000. Okay. Then we need to allocate the non-controlling interest share. So the non-controlling interest has 20%. So we're going to go share capital 500,000 times 20%, and that will show NCI's portion of share capital is 100,000. Okay. And we're going to do the same for retained earnings. We'll take 80,000 multiplied by 20%. That will give us NCI's portion of 76,000 Rand. Okay. Then we know the consideration paid by P for equity for 80% was 720,000. Okay. So we have our consideration of 720,000. So we need to determine, is there goodwill or gain on bargain purchase? So we paid 720,000 Rand for 80%, which represents 704,000 Rand. So we know that we paid more than what the equity is worth in book value terms. So we know that therefore there's goodwill of 16,000 Rand that needs to be created. Okay, so that is the at acquisition process. You should all be familiar with that because it was done in prior years. Now look, B, between, okay, slash since, this is the period since acquisition before the current year. Okay, that is represented by this area known as B. Then we have area C, which is known as the current year. And this is the reason why we needed to calculate and split our post-acquisition retained earnings between the current year period and the period from acquisition date to the beginning of the current year. Okay. So let's have a look at the current year because this is the information they've given us. They told us in the scenario there that the profit after tax was 220,000 in the year 2013. So that is our profit after tax. But remember, we have a dividend. S declared a dividend of 20,000 Rand. So we are going to go profit 220,000 Rand minus our dividend, because when a company declares a dividend, it does impact the retained earnings figure. Okay, so we're showing our current year effect. So do you agree, if we look at C here, the post-acquisition retained earnings relating to the current year is 200,000. It is calculated by taking the profit after tax of 220,000 less the dividends of 20,000. Okay. So the post-acquisition profits for the current year is 200,000. Now we need to determine the section B here. So we need to take our total for our post-acquisition profits, and we need to subtract the amount that relates to the current year. Okay, so the way it's done it here, it has taken the 900,000 being the closing balance of retained earnings, and it has subtracted the retained earnings of 380,000 Rand. So this relates to the pre-acquisition retained earnings. We are trying to calculate the retained earnings here from acquisition date to beginning of the current year. So we're doing that by taking the total retained earnings closing balance of 900,000 Rand less the portion relating to our pre-acquisition retained earnings of 380,000 Rand. That was eliminated, okay? Then we need to subtract the current year retained earnings of 200,000 Rand. So this will then give us our retained earnings from acquisition date to beginning of the current year of 320,000 Rand. Okay, do you guys understand that? It is simplified in the diagram, which we had a look at earlier, but this is how we do it in the analysis of equity. Now remember, when we look at the amounts here, 320,000, and we have our profit of 220,000, this represents 100%. But we know that P does not own 100% of S. It owns 80%. So P's share of this retained earnings will take 320,000 multiplied by 80%. This will give us 256,000. Then we have profit after tax being 220,000. P's share of this is 80%, being 176,000 Rand. Then we have NCI's portion here. So NCI's portion is calculated as 20%. So we're simply going to go, say, retained earnings of 320,000 multiplied by 20%. That is going to give us 64,000. Then we have profit after tax of 220,000 multiplied by 20%. That will give us NCI's portion of 44,000 Rand. Okay. And so on. The same for dividends. Do you guys see now? So we did it in the diagram format. This is how you do it in the analysis of equity. Okay, so someone is asking, we subtracted the pre-acquisition profit and the current year retained earnings to find part B. That is 100% correct. But remember, we did it this way because this is what the information told us. But if the information changes, you may have to calculate it a different way. So my best advice is to understand it. Don't just say, okay, well, I'm going to calculate B by taking this minus C. You need to understand it, because what happens if they give you B and they require you to calculate C, being the current year profit? Okay, so you need to understand it. In this situation, they gave us the closing balance of retained earnings. They gave us the pre-acquisition retained earnings of 380,000, and they gave us the current year profit and dividends. So because of that information they gave us, we could calculate the retained earnings from acquisition date to beginning of the current year by using those numbers given to us. But if they change the information, this could change the way we calculate it. So it's best to understand, how to calculate it every way. And the only way you can do that is by practicing and going through your tutorial questions and your practical questions. Okay. Well, I think if you understand the process, then no way they give you the information should be too complex. Okay. I mean, there has to be a way to calculate it. So you just have to understand what you're doing properly. Okay. So let's have a look at the next slide. So now we need to think about goodwill. Is goodwill recognized in the separate financial statements of the parent? Is goodwill recognized in the separate financial statements of the parent? No, listen, is goodwill recognized in the separate financial statements, in the individual financial statements? Okay, no, it's not. This idea of goodwill is going to be created and recorded in the consolidated financial statements. So we have a separate account for P, the company, but then we prepare consolidated financial statements for the group. When we prepare consolidated financial statements, we need to pass a journal entry for goodwill. And that is what was done in the at acquisition pro forma journal entries. When we set off the equity against the investment in S, we saw there was goodwill. The goodwill in this question was 16,000 Rand. Now we need to amortize this goodwill. So sometimes they will tell us in the scenario that goodwill should be amortized over 5 years or 6 years. In this situation, I don't think they told us. So if the question doesn't tell us how to amortize goodwill, what period do we need to do it over? Okay, so if they tell us in the question, amortize goodwill over 5 years, you're going to amortize it over 5 years. If the question is silent and they don't tell us any amortization period, we will amortize goodwill over 10 years. Okay. So in this lecture example, they did not tell us. So we are going to amortize it over 10 years. So we're going to take a goodwill of 16,000 Rand and we're going to divide it by 10 to get our amortization of goodwill for the current year. So we have calculated our amortization for the current year by taking 16,000 Rand being goodwill divided by 10. So now we need to determine what are our journal entries for goodwill. For the current year, we're going to go debit amortization expense, and you know this is in your profit and loss statement, and you're going to credit accumulated amortization. And you know this accumulated amortization is in your statement of financial position. So this is the journal entry to amortize goodwill during the current year. Now, to amortize goodwill, so remember when we prepare the group financial statements, we need to process all these journal entries from scratch, basically. So when we're preparing the financial statements on the 31st of December 2013, we also need to process the pro forma journal entry to account for the amortization of goodwill for the 2011 year and 2012 year. So here we are going to go debit retained earnings, and this represents your accumulated profits. So in the current year, we said debit amortization expense, but here we're going to go debit retained earnings because that is your accumulated profit, and this journal entry relates to prior periods. So debit retained earnings and credit accumulated amortization. So your retained earnings is in your statement of changes in equity, so you'll just put that in brackets, and then you'll credit accumulated amortization, and this is in your statement of financial position. So remember now, this amortization here that we're doing is for 2011 and 2012. So it's 2 years worth of amortization. So remember, we calculated the amortization for 1 year being 1,600. Therefore, because it's for 2 years, our journal entry is going to be 3,200. Okay, so someone has asked if they process the journal entries like they did in the chat, is it wrong? It's not wrong, but the problem with this is that you're more likely to make a mistake. So I would separate the journals if you have time. They are both correct, but the problem is that I find when students combine journal entries, they sometimes make silly mistakes. So you can do it that way, it is correct, but just remember, just make sure you don't make a silly mistake, okay? So this is the journal entry to amortize goodwill, okay? It looks like you all understand that. Remember, we're processing goodwill for the current year, and then we need to process it for the years 2011 and 2012 as well. So let's have a look at the next slide. Okay, so now we're having a look at our statement of changes in equity. And students often battle with this, okay, but let's do it systematically, and then hopefully you'll understand where all of the numbers came from, okay? So what helps here is to have your analysis of owner's equity next to you, and this will show you where the numbers come from, okay? So here our aim is to calculate our opening balance of retained earnings. Okay, so in this slide we're going to look at the opening balance of retained earnings. How did we calculate our opening balance of retained earnings? So here the opening balance is 1,392,800. Okay, so how did we calculate this? Let me just go to my statement of owner's equity. Okay, so it's telling us there, okay, this opening balance of retained earnings, based on the information they've told us, we are going to calculate the opening balance by taking the 1,500, which is our closing balance of retained earnings for P, So we need to decide what is included in our opening balance of retained earnings. There's a portion of P which represents 100% of P, and then we also need to include S. But remember, we cannot include the total opening balance of retained earnings for S because a portion of this related to the pre-acquisition retained earnings. So S's portion is going to be just the post-acquisition retained earnings, okay? So if we look at P, what is P here? So we're looking at the opening balance. So if we take the closing balance of P, they told us that the closing balance of P is 1,500 Rand. So we want to know what is the opening balance. So to get to the opening balance of P, we need to subtract the current year profits and dividends from the closing balance of retained earnings to get P's portion of the opening balance of retained earnings. Okay, so it sounds complicated. That 40,000 Rand is the dividend. So remember, P's retained earnings closing balance in its individual book was 1.5 million. Then we're minusing the profit, which was made of 400,000 Rand, and we paid 40,000 dividends. So when we pay dividends, that also reduces retained earnings. So 100% of P's opening balance of retained earnings is 1,140,000. Then we need to assess, well, what portion of S's retained earnings can we include in here? So S's retained earnings, we also need to add in here. So this is going to be 256,000, and that should come from your statement, your analysis of owner's equity statement. Okay, but remember now, S in the opening balance here is not going to include the current year profits. So the post-acquisition retained earnings is made up of current year profits and then that portion from acquisition date to the current year. Because we're calculating the current year here, because we're calculating the opening balance, this will not include S's current year profits, because S's current year profits will be shown in the total comprehensive income down here. Okay, so this 256,000, this is S's post-acquisition profits to P, but it's that portion that is in the opening balance of retained earnings. Okay, it is not the current year portion. Then we also need to account for the annual amortization of goodwill for 2 years. So this amortization for 2011 and 2012, this also would have reduced the retained earnings. So the opening balance needs to be reduced for the amortization of the goodwill for 2011 and 2012. The 2013 goodwill, in other words, the current year goodwill, that will obviously not be included in the opening balance. Okay, that will be included in the closing balance. Okay, so our opening balance of retained earnings is 1,392,000 Rand and 800 there. Okay, so that is the opening balance. Do you guys understand how we calculated the opening balance of retained earnings? Okay. I know it is a bit confusing. I also had to sit down and break it down, but I highly recommend going through the slides again. Okay, so what is the 1,140,000 for, or 1.14 million? That is the opening balance of retained earnings. So our aim here is to prepare our consolidated statement of changes in equity. So in order to do that, we need the opening balance. And the opening balance is here. It is 1,392,800. But remember, this consists of P, 100% of the parent company, a portion of the post-acquisition profits of S, and then we also need to take into account the amortization for 2011 and 2012. So that 256,000 from S's post-acquisition profits, that is the 80%. Okay, we cannot include 100% in our retained earnings column because we also have NCI. Let me just go to that statement of owner's equity just to confirm that. So that 256,000, you'll see it's in the 80% column, meaning it is 80% of that 320,000. So remember when we had the diagram, we said the post-acquisition profits, we said the post-acquisition retained earnings from acquisition date to beginning of current year was 320,000 Rand. That represented 100%, but P only has 80% of that. So 320,000 multiplied by 80%, that will give us 256,000. Okay, so that is correct. That 256,000 represents 80%. And then NCI here, these figures will also come from that statement of change of equity accounts. And this will just be the NCI's portion here. Okay, you'll see that the total 280,000 here agrees to the analysis of equity's total of 280,000. Okay, that looks correct. Okay, so that is correct. Yeah, if you follow this working, I see you have the same working there in the chat group. Okay, so guys, that is the opening balance of retained earnings. We need to move on to the other balances, otherwise we're going to be stuck here forever. Okay. But I do recommend you need to go through these slides on your own, okay? You need to, unless you've read through the slides before the lecture, it might be difficult to follow because there's so much information. So let's have a look at the closing balance of retained earnings. So here they told us, remember the closing balance in our consolidated statement here, this is the group. The closing balance of retained earnings is going to be made of P and S, okay? So P's closing balance of retained earnings was 1.5 million. They gave us that in the scenario. Now we need to add in S's closing balance of the retained earnings. So how do we get S's total post-acquisition profits? So how do we get the 416,000? Can anyone tell me? Okay, if you have a look in your analysis of equity slide, which is on slide 19, I think, it is made up of the post-acquisition profits, which includes the current year and the period from acquisition date to beginning of current year, but the 80%. Okay, so let's see, 520,000 times 80%, that is 100% correct. So that 416,000 Rand represents 80% of the post-acquisition profits. Okay, but remember we need to also take into account our dividends, which that post-acquisition profit amount does. So now we have P share, which is 100% plus S's share of post-acquisition profits. Remember, we have amortization now. Now we are calculating the closing balance, and the way we have done it leads us to include the total amortization of Goodwill for 3 years. Okay. So because we are looking at the closing balance, you need to ask yourself how many years was Goodwill amortized for? And it was amortized for 3 years. So that is going to give us 4,800 being annual Goodwill of 1,600 multiplied by 3. So if we take this into account, P plus S minus the amortization of Goodwill, which would have been processed in prior years, this is going to give us a closing balance of retained earnings of 1,911,200 Rand. Okay, so this is the closing balance. So far we've calculated the opening balance plus the closing balance. Now we need to have a look at how to calculate the total comprehensive income. Okay, So let's have a look at the next slide. So if we have a look at the next slide here, it shows us how to calculate the total comprehensive income in our group financial statements. So here, this total comprehensive income is going to include 100% of P. And they told us there that P's profit for the current year was 400,000 Rand, okay? So we have P's profit of 400,000 Rand. Now we also need to include S. So how are we going to include S? S is going to be included, we're going to include the 80% of S from part C in your analysis of equity accounts. And this is the 176,000 less the dividend, okay? So S would have declared dividends of 16,000 Rand during the year. So we need to take this out of the profit, okay? The dividends here are 40,000. This is P's dividends only. So this is the dividends that P is showing. Let me just go back to the question so I can show you where the information is. So if you look at the question there, I'm not going to put it on the screen because it's quite far back. But if you have a look at the question, it said P made a profit after tax of 400,000 in the scenario and declared dividends of 40,000. Okay, so these dividends were declared and we're going to show that in our group financial statements. But remember now, S made a profit of 200,000. Wait, was it? So let me just see, sorry, S made a profit of 220,000 and they declared dividends of 20,000. But remember, this profit of 220,000, it doesn't all relate to P. It doesn't all belong to P. A portion belongs to NCI. So when we're calculating our profit here, we are going to take our 80% of that, which is 176,000 minus 80% of the dividend, which was 16,000, and that is going to give us S's current year profits, okay, after declaring dividends. Then we will include the annual amortization of Goodwill. Remember, we passed that journal entry for Goodwill and we said it was 1,600 Rand for the current year. So if we take P's total comprehensive income plus S's 80% of that, and we take out Goodwill because that would have reduced our profits, or it would have been an expense, so it would have reduced our net profit. This is going to give us total comprehensive income of 558,000 Rand. 558,000 Rand at the bottom there. Okay, does that make sense, guys? If you do it step by step, it does make sense. So, but when I say 200,000, I get 160. So Mutema, remember the profit was 220 minus the dividend of 20. So you're saying 200,000 Rand times 80% is 160,000, which is what they're including there. So that is correct. But remember, the analysis of equity will split it. It will go 220 times 80 minus dividend of 20,000 times 80%. So you'll get 160 both ways. Okay. So that is the calculation for total comprehensive income. I know some of you may be lost. You're welcome to type your questions in there. But for a section like this, you really should have read through the slides before coming. If you are lost, it's fine. Don't despair. You must just go through the slides again and tie up all the numbers. Okay, you can watch the video and tie up all the numbers. So someone is saying, why is the total 560,000? Some items are left out here. So for this example, we're just looking at the retained earnings column, okay? This column here is a total, but it's not 100% correct because look, we don't have any items in share capital there, okay? So let's move on to the next slide. So here, just to reiterate, the same procedure was followed there. We looked at the statement of changes in equity, and we looked at the analysis of equity to help us do that. In that analysis of equity, we still eliminated the equity of the subsidiary against the investment. Then we had a look at any elimination of intergroup items. And then we prepared, the next step would be to prepare your statement of profit or loss in OCI and your statement of financial position. And you would do this by adding line by line items, obviously taking into account your pro forma journal entries. The next step we looked at was to prepare the consolidated statement of changes in equity. And we did that by looking at the retained earnings column. It wasn't a complete statement because we didn't have share capital, but our focus was on the retained earnings column and also what portion goes to NCI. So let's have a look at the next slide. So this is to show the journal entries that would have been processed. So here, what I would recommend is having your statement, your analysis of equity open, and this will show you exactly where the figures come from. So here you are just preparing your pro forma journal entries. So these amounts are found in section A of the analysis of owner's equity. So S had share capital of 500,000 and retained earnings of 380,000 on acquisition date. The consideration paid was 720,000 for the share that P bought, which was 80%. So if we set off the investment in S against the equity in S, we'll get goodwill of 16,000 Rand. Then, because P doesn't own 100% of S, it only owns 20%, we are also going to credit non-controlling interest share of this equity. Okay, so all of these figures come from section A in the analysis of owner's equity statement. And that's why it's so important to do that statement, because it will assist you with your journal entries. It will assist you in preparing all of your different statements. Okay, let's have a look at the next slide. So the next slide here, here we had a pro forma journal entry to account for the non-controlling interest share of the subsidiary's post-acquisition retained earnings up until the beginning of the current period. So here you will look in section B of your analysis of owner's equity. Remember, we were looking at that period from acquisition date to beginning of the current year. And we said S had an amount of 320,000 Rand in post-acquisition retained earnings from 1st of January 2011 to 31 December 2012. But that 320,000 Rand, it doesn't belong all to P. 80% belongs to P and 20% belongs to NCI. So this 64,000 Rand is NCI's portion, and it is calculated by taking the 320,000 multiplied by 20%, which is the NCI's portion of the post-acquisition retained earnings. Okay, so this amount can be found in the last column, being NCI, in part B of your analysis of owner's equity. Okay, so because also it's profits from the prior period, it is debit retained earnings. Okay, you're not debiting your current year profit. It is debit retained earnings because it is profit that was accumulated in retained earnings from prior period. So it's debit retained earnings, credit NCI. Okay, let's have a look at the next slide. Here we have our pro forma journal entries relating to non-controlling interest share of the current year profits of S. So in the current year, S had a profit of 220,000 before the dividend was declared. 80% of this belongs to P, but 20% belongs to the non-controlling interest. So we now need to allocate the non-controlling interest interest portion to the NCI. And we do this by debiting non-controlling interest in your profit and loss statement and crediting non-controlling interest in the statement of financial position. So this is 20% of the 220,000 Rand profit. So we are simply allocating the non-controlling interest share of the subsidiary's current year profit. It's very important to always indicate whether the non-controlling interest journal name is from the statement of financial position or from the statement of profit or loss, okay? Because this shows your understanding of where NCI should be. Okay, so this amount comes straight from Part C in your analysis of owner's equity. Let's see what the next journal entry is. So the next journal entry is relating to our dividends. So here, this pro forma journal entry eliminates the intragroup dividend. So remember, S declared a dividend of 20,000 Rand. 80% of this belongs to P and 20% belongs to NCI. But remember, we need to, the 80% being 16,000 Rand, this is an intra-group dividend, okay? It was declared by S2P. In its separate financial statements, there's nothing wrong with having a dividend declared from S2P. But in the group's financial statement, these dividends are basically being declared by the group and paid to itself. So it doesn't make sense from a group perspective. So when we prepare the group's consolidated statements, we need to eliminate this intergroup dividend. And the journal entry we do is to debit dividend income. We're basically stripping out this income from P's books of 16,000, and then we're debiting non-controlling interest being 4,000 Rand, and then we're crediting our dividends Class A account from our statement of changes in equity. So these figures all come from Part C in your statement, in your analysis of owner's equity. So the total dividend declared was 20,000 Rand from S. This was declared to all of its shareholders. P has 80% of this dividend by virtue of their ownership, and NCI has 20%. This journal entry eliminates the intragroup dividend, okay? The intragroup dividend being 16,000 Rand, the remainder is NCI's portion. Okay, all of these figures are in that analysis of owner's equity statement, which is why it's vital for you to prepare that in a situation of a test or exam. Okay, let's have a look at the pro forma journal entries for Goodwill. So here we have our Goodwill, and in the current year we calculated our amortization of 1,600. So we debit amortization expense because it's the current year amount, and we credit accumulated amortization, okay? Remember, in this question, the life of Goodwill was not given, so we amortize it over 10 years. Then for our prior years, for 2011 and 2012, we also need to account for the amortization of Goodwill for the 2011 year and 2012 year. So this is for 2 years. So our journal entry will be for 2 years here. So we'll debit retained earnings because it relates to a journal entry from a prior period. And we will credit accumulated amortization of 3,200. So we have our current year journal entry to amortize our Goodwill, and we have our journal entry for 2011 and 2012 as well. So you will see here that the amortization amount is not found in the analysis of owner's equity. So you'll have to identify that there is Goodwill. The Goodwill amount is shown in your analysis of owner's equity, but then you'll have to pass the pro forma journal entries and calculate your amortization for these journal entries. Okay, it's not difficult to do, but just remember, if you see Goodwill in your analysis of owner's equity and you ask to prepare the pro forma journal entries, you must remember to include your journal entries to amortize the goodwill. Okay, let's have a look at the next slide. So the next slide here is another example. It is lecture example 3. So let's have a look here. On the 1st of January 2012, PPTY Limited acquired 40,000 shares in SPTY Limited. Okay, so someone is just asking what happens at the end of goodwill. So once the goodwill has been amortized for 10 years, then there's no more goodwill to amortize. It's been amortized fully. So there'll be no goodwill in your books, but you have to show the process every year. So every year when you prepare your group financial statements, you'll do the pro forma journal entries where you recognize goodwill, and then you will amortize it for the 10 years. So the net effect will be that there's no goodwill in your group financial statements, but you still need to show it in your analysis of owner's equity and pro forma journal entries. Okay, so on the 1st of January 2012, PPTY Limited acquired 40,000 shares in SPTY Limited and paid 600,000 Rand. Okay, we are going to finish. We'll just have to run over. Your next session is at 3:30. Does anyone have a clash with another module before that? Don't think you should, but we'll just carry on until we've finished, okay? On the 1st of January 2012, PPTY Limited acquired 40,000 shares in SPTY Limited and paid 600,000. On this date, SPTY Limited had 50,000 shares in issue and a share capital of 500,000 and retained earnings of 200,000. The purchase was made at acquisition fair value of the net assets acquired. In the year ending 31 December 2013, P made a profit after tax of 654,000 and declared dividends of 50,000. And S made profit after tax of 400,000 and declared a dividend of 40. The respective statements of financial position of the two companies are as follows. So here they give us the statement of financial position of P and the financial statements of S. So these are individual company financial statements. Okay, you can see the share capital here of S. So these are definitely the individual financial statements. We'll have to prepare the consolidated financial statements. If we have a look at the next slide here, we have the statement of profit or loss and other comprehensive income for SPTY Limited and PPTY Limited. So these again are individual financial statements. Then if we have a look at the next slide here, they are telling us what to do. Prepare the following statements for P Group for the year ended 31 December 2013. We need to prepare the consolidated statement of profit or loss and other comprehensive income. Then we need to prepare the consolidated statement of financial position and consolidated statement of changes in equity. Now we need to do this as far as the information permits. There could be one or two figures that we cannot calculate 100% at this stage, but our aim is to focus on those figures we can calculate. So the steps are the same. We need to eliminate the investment in subsidiary against the equity of the subsidiary. Then we're going to look for any intergroup items like intercompany loans. Then we are going to consolidate the remaining common items line by line to prepare our statement of profit or loss and our statement of financial position. Then we'll prepare the consolidated statement of changes in equity. Okay, so that is what we're doing. You should all know the steps by now. So my first question to you is, what is the ownership here? P acquired 40,000 shares in S, and S had 50,000 shares in issue. So if P acquired 40,000 shares, out of the 50,000 shares in issue by S, what is their percentage ownership? So what is their percentage ownership? You should all see that their percentage ownership is 80%. So because P only owns 40,000 shares of the 50,000 shares in issue, it owns 80%. Therefore, it makes sense that our minority shareholders, also known as non-controlling interest, owns 20% of S. Okay, so this is just telling us the ownership. You should have all seen that. Sometimes they won't tell you how many shares are owned, i.e. 80% or 70%. They'll require you to calculate it from the information given. So P owns 80% of the share capital of S. In order to calculate the values for our pro forma journal entries, we are going to prepare an analysis of owner's equity of the subsidiary. Okay, so this is something you've all seen. We just saw it in the previous example. Okay, so let's just have a look where these figures come from. So they told us there S had 500,000 Rand of share capital on acquisition date, and S had 200,000 Rand retained earnings at acquisition. So remember, this is your pre-acquisition retained earnings. This is going to be eliminated on acquisition. Remember, only 80% of this equity is being bought by P. The rest is bought and owned by the non-controlling interest. We were told that in the scenario, P paid 600,000 Rand for this 80% ownership. So the consideration here is 600,000 Rand. So if we see we're paying 600,000 Rand and we're only getting 560,000 Rand worth of equity, it means our goodwill is 40,000 Rand. So we paid more than what we got. Therefore, there's a portion that is attributable to goodwill, and this is 40,000 Rand in this scenario here. Now we need to look at our post-acquisition retained earnings. So they told us in the scenario, okay, remember they gave us those statements. So in the statement of financial position, you can see what the closing balance of your retained earnings was. So let's just have a look at the statement of equity. Okay, sorry. Let's have a look at the statement of financial position. So here you can see that the closing balance of retained earnings of SPTY Limited is 860,000. So this is the closing balance. So now we need to work backwards in order to calculate the other retained earnings amounts. Okay, so I'm not going to flip too much between the slides. You'll just have to go back and have a look. So the closing balance on our retained earnings is 860,000 Rand. And they told us in the scenario, S made a profit after tax of 400,000 Rand and declared a dividend of 40,000 Rand. So during the current year, S had profit of 400,000 Rand and declared a dividend of 40,000 Rand. So that 360,000 Rand comes from the current year profits of S, minus the 200,000 Rand, which relates to the pre-acquisition retained earnings. So once again, similarly to the previous example, we are trying to calculate B here. This is the post-acquisition retained earnings from acquisition to the beginning of the current year. So we're taking closing balance retained earnings minus current year retained earnings minus pre-acquisition retained earnings, and this will give you the retained earnings for the period at acquisition or just after acquisition to beginning of the current year of 300,000 Rand. Now remember, P owns 80% of this, so P owns 240,000 of this, and NCI owns 60,000. Our profit for the current year was given to us. We were told S made 400,000 and had dividends of 40,000. P share is 80% of both of those, and NCI owns 20%. Okay, so that is the analysis of owner's equity in a nutshell. Do you guys have any questions on this analysis before we go to the actual statements? Okay, so let's have a look at the statements then. Now we have calculated the analysis of owner's equity. Okay, well, first we're going to look at the journal entries. So this is nothing new. This simply shows the pro forma journal entry on acquisition. If you look at section A of your analysis of owner's equity, we're going debit share capital 500,000, debit retained earnings 200,000. This is the equity of S, and it is being set off against the amount paid of 600,000 by P. So P paid 600,000. P paid 600,000 for 80% of this equity. Okay, goodwill of 40,000 rand was recorded. A portion of this equity belongs to the non-controlling interest, which is 140,000 rand. Okay, so all of these figures come from that analysis of owner's equity accounts. This is a journal entry you should be able to do in your sleep by now. Okay, let's have a look at this is the pro forma journal entry to account for the non-controlling interest share of the subsidiary's post-acquisition retained earnings up to the beginning of the current period. So in other words, this comes from part B in your analysis of owner's equity account. It is calculated by taking your 300,000 rand being the post-acquisition retained earnings from the acquisition date to beginning of current year. This is NCI's portion, which is 20% of the 300,000 rand. It is in part B in your analysis of owner's equity account. So we're debiting retained earnings because it relates to profit from a prior year, and you're crediting non-controlling interest in your statement of financial position. Okay, so that is the journal entry for step 2. There should be a few more step 2 journal entries. So the previous journal entry was to account for the share of the post-acquisition retained earnings from acquisition date to the current year. This pro forma journal entry, it basically gives NCI the share of the subsidiary's current profit. So the NCI, so S's share of current year profit is 400,000 rand. So we're saying P owns 80% of this, but the NCI gets 20%, which is 400,000 rand multiplied by 20%. So this figure comes from part C in your analysis of owner's equity accounts. So we're going debit non-controlling interest from your profit and loss statement, and you're crediting non-controlling interest in your statement of financial position. So this is the NCI's portion of the current year profits. Okay, step 2 was to eliminate the common intergroup items. So we shared the profit between the NCI for the post-acquisition period. Now we need to eliminate the intergroup dividend. Fine to have this dividend from S to P in its separate financial statements. But in the group financial statements, it is essentially the group declaring and paying a dividend to itself. So this is not good. It is an interim dividend and it needs to be eliminated. So we're going to go debit dividend income of 32,000 rand. This is P's share of the dividend. The total dividend S declared was 40,000 rand. 80% of this went to P, which was 32,000 rand. So we're reversing the dividend income. We're going debit dividend income, and then we're debiting non-controlling interest with 8,000 rand, and that is the non-controlling interest share of the dividend. And the total dividend was 40,000 rand. So we debited dividend income debited non-controlling interest, statement of financial position, credit dividends, class A. So this is from your statement of changes in equity of 40,000 Rand. So we're simply eliminating the intergroup dividend. Okay, it was similar to the previous journal entry we had a look at. So do all the intergroup transactions fall under step 2? Yes, I suppose you could see it that way, but it's not really important. I mean, we don't expect you to write step 2, step 1 in a test or exam. It's just a step process to allow you to remember so you don't forget to do any pro forma journal entries. But it doesn't have to have a heading. But yes, the intragroup transactions and balances will generally fall under step 2. Okay, now we need to raise our amortization. So the goodwill is not recorded in the individual financial statements. So we raised the goodwill when we looked at that first journal entry on acquisition. Now we need to amortize the goodwill. So here we are using a period of 10 years. So if the question is silent and doesn't give you a useful life to use, then you will use 10 years. If the question tells you to amortize over 5 years or 6 years, then you'll use that useful life. But in this question, we are using 10 years, okay? So we're going debit amortization expense. So this is amortization in the current year for 2013. We're going debit amortization expense, 4,000 Rand. Credit accumulated amortization, and this is for the current year. Now we have a prior year for 2012. So the prior year was, because it is for the prior year, it is debiting accumulated profits, in other words, retained earnings, and we're crediting accumulated amortization. So the acquisition date was from 2012. So this is when we raised goodwill and started amortizing goodwill. So our prior year is only for 2012 and the current year is for 2013. So that is our amortization of goodwill. Let's have a look at the next journal entry. So we are finally at step 3. So here we are going to add 100% of P to 100% of S, okay, on a line-by-line acquisition process. We are going to look at the consolidated statement of profit or loss and OCI, and we're going to look at the consolidated statement of financial position. So just to mention, when we have our statement of profit or loss and OCI, we'll have net profit or loss attributable to the non-controlling interest, and then we'll also have total comprehensive income attributable to the non-controlling interest. So these line items must be shown separately. So you need to show your net profit or loss attributable to your non-controlling interest, and then you'll have your other income items. Then you'll have your total comprehensive income total, and you'll show that portion which is attributable to the non-controlling interest. Okay, it sounds complicated, but it's not when we have a look at it. If there's no other comprehensive income, these figures are the same. Okay. So let's have a look at our consolidated statement of profit or loss. So here we are adding P and S together, okay? We had that dividend income. This is the dividend that P received from S, okay? These are the separate financial statements. So we have P Limited and we have S Limited, and this is the consolidated column over here. So you can see we're going P Limited plus S Limited. Dividend income for P plus S. Okay, there's obviously an elimination. Remember, we processed that pro forma journal entry, which eliminated the dividend income from S to P. So even though it's shown in P Limited separate financial statements, it was eliminated on consolidation, so it won't be shown in the group financial statements. Then we have amortization of 4,000 Rand. That is the amortization for the current year. Then we total to get our profit before tax, and we have our tax expense, and then we have our profit for the year. Then we have other comprehensive income, which is nil, and we have total comprehensive income. Now we're showing the total comprehensive income attributable to owners of the parent and NCI. Okay, so if you go to your analysis of owner's equity account, you will see that 80,000 Rand is the total on the NCI, sorry, it's the profit for the year on the NCI column of 80,000 Rand. Okay, then you can take the total amount being 1,018,000 less the NCI of 80,000, and that will give you 938,000 Rand. Okay, so it's just showing you how to do your consolidated statement of profit or loss. So you're just adding P and S. Obviously, you need to remember those pro forma journal entries, because that could change some of the figures. Just like dividend income was eliminated on consolidation, our amortization was not in any of the individual companies, but we processed that pro forma journal entry. So it will be shown here in your consolidated statement of profit or loss. Okay, let's have a look at the next slide. So they are just showing you the process here in that statement, in that consolidated statement of profit or loss. You simply added 100% of P to 100% of S, line by line for assets and liabilities. And then your equity section, this must consist of your equity attributable to the owners of the parent and your NCI. So let's have a look at the next statement. So here's your statement of financial position. They have simply recapped, this is the statement of financial position for P Pty Limited and S Pty Limited in its separate financial statements. This was given in a previous slide as well. So let's have a look at how to combine these separate financial statements into the group financial statements. So here we have our analysis of owner's equity account. This is the same analysis at which was previously recorded, and previously we went through this. Okay, it's just showing it here so that you can find the numbers to go into your statement of financial position. So if we have a look at the consolidated statement of financial position, okay, so if you have a look at your consolidated statement of financial position, it's showing P Pty Limited and S Pty Limited, and then you have your pro forma journal entries. So you have your consolidated figure here. So you're simply taking P plus S to get your consolidated amount. Your investment in subsidiary, this was netted off the equity in that pro forma journal entry. Then we had Goodwill, which we recorded of 40,000 Rand, and then we amortized this over 10 years. So the current year amortization is 4,000 Rand over here. So this Goodwill balance is showing the Goodwill net of amortization. Then we have our trade receivables, inventory, and bank. All of these are simply adding P and S together. Once you have your consolidated column, you can simply total it to get your total assets figure. Then for equity, here we have share capital of P and share capital of S. Remember, we processed that pro forma journal entry, which eliminated the 500,000 Rand, and this was the pre-acquisition retained earnings of S. So left over, we only have 900,000 Rand. So it's P plus S plus our pro forma journal entry will give us 900,000 Rand of share capital. Then we have retained earnings. So P's retained earnings was 1,000 1.8 million, and S had 860,000. Then we had these adjustments here which were made. Just see if I can find these figures. So that 4,000 Rand relates to amortization for the previous year. Okay, so that 4,000 Rand relates to amortization for the previous year, and that 332,000 Rand, this would be from your statement, your analysis of owner's equity account. Okay, it's one of the journal entries as well, the pro forma journal entries. This probably shows the total of all of the journal entries that affected retained earnings. Then we have non-controlling interest. So this was 272,000 Rand. And if you go back, that should agree to your analysis of owner's equity account, the total of the column there. Okay. Let us have a look now at the statement of changes in equity. Okay, wait, we still have this. Okay, this is just showing it in more detail. So this is showing the equity portion. So you will see here that it's focusing on the equity. Okay, so this is going to help us when we are preparing the consolidated statement of changes in equity and the consolidated statement of financial position. So here we looked at the share capital, and then the retained earnings, we're taking P plus S, and then they've broken down that journal entry to retained earnings. Okay, so this is made up of all of the pro forma journal entries. So remember, we had 4,000 Rand relating to the amortization of Goodwill. We processed that pro forma journal entry. That 72,000, that was the non-controlling interest share of current year profits. The 60,000 Rand was NCI's post-acquisition retained earnings amount, okay? And that 200,000 Rand was the at acquisition or pre-acquisition retained earnings of S. So you can see all of those journal entries we looked at come together here in this pro forma journal entry column. So it's simply here we're adding P plus S plus the total of all of these pro forma journal entries, and that will give us our consolidated retained earnings figure. Then we had NCI, and then the trade payables here is simply P plus S, and that gave us our consolidated trade payables. Okay. So it is something you have done before. It's just a bit more complicated now with the retained earnings. Okay, it is a bit complicated, but you need to go through it systematically. Are there any questions on any of these slides before I move on? Okay, I know you guys might be a bit lost, and that's okay because there's a lot of information. But what I want you to do is to go through all of these slides again and see if you know where all the numbers come from and if you understand the process that was done to get to the numbers. Okay, you guys are very quiet. Will this be included in test 3? I don't think it is because you guys wouldn't have had a practical or tutorial on it. But remember now, like you have all those other weeks from consolidations. So you still need to like study the consolidation section, but it shouldn't be as complicated as this. Okay, let's have a look at the next slide. We are nearing the end. I see someone's lowering their hand. Is there a question?
Yes, ma'am, I have a question. Can you please go to the previous slide?
Yes.
So, ma'am, here when I add all these PFJE accounts, I don't get 560,000.
It wouldn't be 560,000 though. The total of the pro forma journal entries excluding the goodwill, should be 332,000 rand. So that 500,000 is share capital. So that 500,000 rand is share capital. That's the pro forma journal entry for share capital. If you
Yeah, I mean
add
the
these journal, sorry?
So like so for total assets and total equity and liabilities, you have negative 560,000, negative 550. Yeah,
Okay.
560.
I wonder if some of the signs could be wrong. Are you adding in the non-controlling interest as well of 272,000?
I'm using
I'm
the
going to add it
differences.
quickly.
Sure.
Okay, is it 564,000? Are you getting 564,000? Okay, so I think it's just
That
the
is
amortization here has somehow been shown separately. So if you think about that amortization, it is a pro forma journal entry. So yeah, I get 564,000 when I add it here. They seem to
yeah,
have
me too.
somehow shown this 4,000 separately. Is that what you get?
Yeah, I also get 564,000. So I
Yeah,
think
but I mean,
the
it's fine because,
assets could also be the 564,000.
yeah, so I suspect the difference relates to the 4,000 of amortization. But I mean, this is just a total column. Like, there's usually not many marks, or if any marks associated for this. It's more important to focus on these amounts here, okay? You could even show these amounts separately, and then this would assist you to get like method marks. Okay, someone is asking, where did we get the 72,000 Rand? Let me just have a look. So that 72,000 Rand, that is the non-controlling interest share of the current year. So remember, we processed that pro forma journal entry, and we were giving NCI their portion of the current year retained earnings. So that is where the 72,000 Rand comes from. If you go back to the pro forma journal entries, you'll see that we debited retained earnings with 72,000 Rand, and we should have credited NCI with 72,000 Rand. Okay. Okay, let me carry on, guys, because it is just getting a bit late and I can hear we're all getting a bit tired. Okay, so let's just have a look at step 4. Step 4 is to prepare the statement of changes in equity. So the statement of changes in equity, it must only show the amounts attributable to the parents in the reserve accounts. Okay, so the share capital and retained earnings must only show the portion that is attributable to the parent company. There's a separate column of total equity of parents that is shown, and then we have a separate column for non-controlling interest. Then the last column, total equity, that will add up the total equity of the parents and the non-controlling interests equity. Okay, so let's have a look at an example here. So it's just saying when you do the column in the statement of changes in equity, you need to show the equity that belongs to the parent, and you need to show the equity that belongs to NCI, and then you're going to total those two. So they have given us this reconstruction of the statement of changes in equity. Here we have closing balance. We were told the closing balance of the statement of changes in equity for P and S Pty Limited. Now we just need to calculate the opening balance over there, okay? So let's just, so it's not a difficult exercise here. So here we have the closing balance of retained earnings, and we're simply going to work backwards. So we're going to add 40 and minus 400, and we should get the total. I don't know why, if this is working. Okay. So if you have a look at 860 and you add 40 and minus 400, what do you get here as the opening balance of S Pty Limited? So you take 860 plus 40 minus the 400,000, that will give you an opening balance of 500,000 here. And then for P Pty Limited, you have a closing balance here of 1,804,000, and you have dividends of 50,000 and total comprehensive income of 654,000. So your closing balance, you're working backwards here, so you're going to take your closing balance plus your dividends minus your total comprehensive income, and that will give you an opening balance here of 1.2 million. Okay, so you're simply working backwards. So this one isn't too tricky compared to some of the other ones, but now we'll need to use this information to calculate our statement of changes in equity. So again, if you have a look at the next slide, again, it shows, so here it shows your opening balances, which a lot of you were able to calculate. So we calculated these opening balances here for the 1st of January 2013. So the next slide here again shows that analysis of owner's equity. It is the same as the previous one. I think I just put it here so that you wouldn't have to flip back so much. Okay, so this is something we went through. Okay, so you should all know how to calculate these figures. We're going to use this analysis of owner's equity to help us do the statement of changes in equity. So here you have your statement of changes in equity. We have our share capital of 900,000. Remember, this share capital is just P's share capital. Then we have retained earnings of 1,436. Then we have our total, and then we have our NCI of 200,000. And we have our total equity over there. Okay, just gonna open, okay, so I've got my analysis of owner's equity account open. So then we have our total comprehensive income statement. It's just difficult to have so many slides open. Okay, so we have our total comprehensive income for our retained earnings, and then we have NCI's portion of 80,000 over here. Okay. So we are basically, okay, so the opening balance for retained earnings, the 1,436, so that 1,2, that is the opening balance of the retained earnings, which we just calculated on slide 53, plus the 240,000, that is from the analysis of owner's equity. That would be the retained earnings for S, the post-acquisition retained earnings from acquisition date to beginning of current year. And then the 4,000 Rand would be the prior year amortization. Okay, so that gives us the opening balance on our statement of changes in equity. Then so this 240,000, remember it's the 80%, it's the P share. So that gives us the opening balance. Then the closing balance will be calculated by taking the closing balance of P's retained earnings, okay, which was in that previous slide. Then the 528,000, we are adding S's share of post-acquisition retained earnings. Remember, it'll be just the 8%. And then also we have to take out the dividend. Then we have the 8,000 Rand amortization. So because we're calculating the closing balance of the retained earnings, here we are showing the amortization for the current year and the prior year. So that's 72,000 Rand. I'm just not sure where you're referring to, Medea. Is it this slide or a previous slide? Okay, So you can just think about that previous. Okay, well, let's just finish. Okay, let me just, what slide was it? Was it the analysis of owner's equity? There are quite a few previous slides. Okay, maybe you can just email me or ask at the end because I don't want to hold the whole class up. I think they want to finish. So let's just carry on and maybe you can just ask me. So it's slide 50. So I think I mentioned that. Let me just go to slide 50 on my other laptop. So that's 72,000. I'm assuming you're talking about the pro forma journal entry in retained earnings, that column. So that's 72,000 Rand. That is the NCI current year profit. Okay. It's the NCI current year profit. You can just have a look at your journal entries in the slides and you should see that amount there. Okay, so for this slide now, we've calculated the opening retained earnings and the closing retained earnings. So here are the calculations for when you do it yourselves. Do you have any questions on this slide? Your total comprehensive income, that should be shown, I think in one of the previous slides, and then you have NCI share. So this total comprehensive income will actually come from that previous slide where we calculated the total comprehensive income. Remember when we did the statement of profit or loss? So if we have a look at the statement of profit or loss, just going there. So here you prepared this consolidated statement of profit or loss. Here you have your owners of the parent. So you have your total comprehensive income attributable to owners of the parent being 938,000, and you have your NCI being 80,000. So these amounts are then taken to the statement of changes in equity, and we are using those figures which we calculated previously in our statement of changes in equity. Okay, let's just show you. So here is the total comprehensive income. This is the parents' portion, and this was the NCI's portion. So this total here agrees to the consolidated statement of comprehensive income or consolidated statement of profit or loss, whatever you want to call it. And then we have our dividends here. And yeah, so that is this statement here. Do you guys have any questions on this slide? Okay, if not, I think let's move on. We'll try to go through these next ones relatively quickly. You can just stop me if you have any questions. Okay, so this slide is just saying that intergroup transactions are not limited to dividends. You can also have non-current assets sold within the group. So when you think of intergroup transactions, you might think of like the subsidiary declaring a dividend to the parent, but there can also be other transactions. So other transactions that can happen is when an asset is sold from the subsidiary to the parent or vice versa. So when we have a situation like this, when we prepare the consolidated financial statements, the asset needs to be valued as if the sale had not taken place. So if S makes a sale of a non-current asset like a vehicle to P, in the separate financial statements, it is fine to record the sale. But when you prepare the group financial statements, you're essentially saying that you sold this vehicle to yourself, which doesn't make sense. So for the group financial statements, you will need to like strip out the sale of the asset and pretend that it had not occurred. This means that the non-current asset, like the vehicle, must be restated to the original cost or revalued amount. Any profit or loss on the sale will need to be eliminated. Okay, so we're going to look at the situation where we have a sale of a non-current asset within the group. So because the separate entity that acquired the asset will be depreciating the asset, this will be less than the original cost. Okay, so in the separate financial statements, if S sells a vehicle to P, obviously S is going to account for the sale, and P will acquire that asset at an amount, at a cost to itself. And this will be more or less than the original cost. So there's usually a need to adjust the depreciation as a result of the intergroup sale of the non-current asset. So obviously if S sells a vehicle to P, P acquires that vehicle at a different amount to what it was originally bought. And then P will depreciate that asset based on that new cost to itself. So from the group's perspective though, no gain or loss on sale should be recorded. So like I said, if S sells a vehicle to P, it is found in the separate financial statements, but in the group financial statements, it doesn't make sense because you basically sold an asset to yourself. So we will need to reverse this sale. Okay, so let's have a look at an example, and I'm sure that'll answer all your questions. So here we have example A. On 1st of April 2011, Eddie acquired 100% of Sandy Limited for $850,000, representing the fair value of the consideration transferred. On this date, Sandy had share capital of 500,000 Rand and retained income of 300,000 Rand. All the assets of Sandy were fairly stated on acquisition date. On 1st of April 2011, Eddie Limited sells an item of plant to Sandy for 780,000. Okay, so in this example, the parent is selling to the subsidiary, but it can be the other way around. So let's have a look at the solution, or let's have a look at what is required first. So the plant costed Eddie Limited 1 million Rand, was 4 years old, and had accumulated depreciation of 400,000 Rand at the date of sale. The remaining useful life of the plant is assessed as 6 years. So now we need to prepare the journal entries relating to the sale of the plant in the books of Eddie, and we need to prepare the journal entry relating to the sale of the plant in the books of Sandy. Prepare the necessary pro forma journal entries at 31 March 2012. Okay. So let's have a look at those journal entries. So in this situation, Eddie has sold an item of plant to Sandy. So we are looking now at Eddie's books. Okay, so now this is Eddie's separate books, okay? This is not the consolidated books. This is Eddie's separate books. How are we going to account for the sale that Eddie has sold to Sandy? So Eddie sold this to Sandy for 780,000 Rand. So the first thing we're going to go do is debit bank 780,000 Rand. Eddie has sold this item of plant and its bank account has increased by 780,000 Rand. Then it needs to reverse the accumulated depreciation. So they told us in the scenario that the accumulated depreciation was 400,000 Rand, and this represented 4 years of depreciation. So Eddie would have gone debit depreciation, credit accumulated depreciation for 4 years. Now that it's sold that item of plant, it needs to reverse the accumulated depreciation. So we're going to go debit accumulated depreciation plant, and then we're going to go credit plant cost of 1 million. So Eddie paid 1 million for this item of PPE. Now it's going to reverse the cost in its books. Okay, so the net effect of reversing accumulated depreciation and reversing plant, this essentially shows the carrying amount. Okay. Then we need to see if there's a profit. So as a result of these transactions, we can see there is a profit on sale of the plant of 180,000 Rand. So there's a gain of 180,000 Rand. So this profit will be shown in the books of Eddie, its separate financial statements. Okay. So when we now prepare the group financial statements, this profit here will need to be reversed, okay? Because it has sold to a company in its group. This profit will need to be reversed when we prepare the consolidated financial statements, and this accumulated depreciation and carrying amount will need to be reinstated, okay? So this is showing it from Eddie's perspective. Let's have a look at Sandy's Limited's books. So in Sandy's separate financial statements, Sandy has bought this wonderful plant from Eddie. This plant cost 780,000 Rand. So in Sandy's books, Sandy is going to record this plant at a cost of 780,000 Rand. And it paid for this plant using its bank account. So we go debit plant 780,000 Rand, credit bank 780,000 Rand. Now Sandy is going to depreciate this item of plant based on this cost that Sandy paid. So Sandy has, when Sandy bought this asset, it had been depreciated for 4 years. The remaining useful life of the plant was assessed as 6 years when Sandy bought it. So Sandy will depreciate this plant by taking 780,000 and dividing by 6, and that will give us 130,000 Rand depreciation. So debit depreciation 130, credit accumulated depreciation plant 130. So we have just seen how Eddie and Sandy will record this transaction in their own books. However, when we look at it from a group perspective, we are not happy because it appears as if we sold this asset to ourselves, which doesn't make sense. So from a group perspective, we're saying, no, this asset sale didn't actually take place. The asset was simply transferred from one room to another, essentially. So we cannot record a sale for this item. So Eddie recorded the profit in its financial statements. Now the pro forma journal entry will pretend that the sale didn't take place. So it will go debit profit on sale plant, 180,000 Rand, reversing the profit that was seen to be made by Eddie. Then we'll go debit plant, 220,000 Rand. We are basically reinstating the cost of this plant. Remember, Eddie had it in its books for 1 million, and it subsequently reversed this cost of 1 million. And then Sandy recorded it for 780,000 Rand. But we want it to be recorded at 1 million. So we want to show that the cost is 1 million. So because Sandy would have recorded it as 780,000, we need to add 220,000 to take it to its original cost of 1 million. We are pretending that the sale didn't take place. So currently Sandy is showing the asset in its books for 780,000 Rand, but we know the original cost was 1 million. So we're going debit plant 220,000 Rand to bring the 780,000 Rand up to its original cost of 1 million. Then we have accumulated depreciation plant. So here we are reinstating the accumulated depreciation. Eddie would have recorded the 400,000 Rand, and then it would have reversed the accumulated depreciation when it sold the asset. Here we are reinstating the accumulated depreciation. Okay. So here we are, this is what I've explained. So the sale was made by the parent. So the profit is sitting in the parent's books. So the analysis of equity will not be adjusted for this unrealized profit. So here you will just show it in the journal entries, okay? So do you understand that the separate financial statements, it's fine to show the sale of asset, but in the group financial statements, we cannot show it, okay? Then obviously we need to pretend that this asset was never depreciated by Sandy. So we're going to reverse the depreciation that Sandy processed in its books. So we're going to go debit accumulated depreciation plant of 30,000, and we're going to credit depreciation of 30,000. So Sandy would have depreciated the asset by 130,000, but from the group's perspective, the depreciation charge should have been 100,000 Rand based on the previous cost and useful life. So therefore, we need to reduce the depreciation so that we are bringing it from 130,000 Rand to 100,000. We're basically pretending that this sale never took place. So we want the depreciation to be what it would have been had this asset never had been sold. So if Eddie kept this asset, he would have continued to depreciate it by 100,000 Rand. So that's what we want the depreciation to be. Sandy is depreciating it based on its new cost of 130,000 at 130,000 Rand of depreciation. So we want to pretend that the sale never took place. So we want to record the depreciation at 100,000. Therefore, we are simply reducing the depreciation processed by Sandy by going debit accumulated depreciation, credit depreciation. Okay, one more. I think this should be the last example. On the 1st of April 2011, Eddie acquired 100% of Sandy for 850,000, representing the fair value of the consideration transferred. On this date, Sandy had a share capital of 500,000 Rand and retained earnings of 300,000 Rand. All the assets of Sandy were fairly stated on acquisition. On the 1st of April 2011, Eddie sells an item of plant to Sandy for 780,000 Rand. So this plant cost Eddie 1 million, was 4 years old, and had accumulated depreciation of 400,000 Rand. At the date of the sale, the remaining useful life of the plant is assessed as 6 years. Prepare the necessary pro forma entries as at 31 March 2013. Okay, so let's have a look at the pro forma journal entries. So because we are consolidating 2 years after the acquisition of the subsidiary, now we are using retained earnings, okay? So the figures have stayed the same, but now we are doing the transaction using retained earnings. So we're going debit plant 220,000, credit accumulated depreciation plant, and we are reversing the profit recorded in the books of Eddie in the prior year, and we are reinstating our accumulated depreciation. So previously, in that previous example we debited profit on sale of asset being 180,000 Rand. But here, because we are now not in that current period, instead of debiting profit on sale, we are debiting retained earnings being 180,000 Rand. So the numbers are the same. Any item that relates to the statement of comprehensive income or statement of profit or loss will now go through retained earnings because that's where the prior period profit is sitting. Okay, so we're debiting retained earnings here. And if you compare this to the previous example, we debited profit on sale of plant. Then if we have a look at this slide, so here we are debiting accumulated depreciation plant and crediting depreciation. So previously there was just 1 year of depreciation we needed to adjust for. Now there are 2 years. We're adjusting for the depreciation for the current year, and we're adjusting for the depreciation which was included in the profit and retained earnings in the prior year. So we're going debit accumulated depreciation plant, and we're crediting depreciation for current year depreciation and crediting retained earnings for depreciation relating to the prior year. So remember, we weren't happy with the depreciation processed by Sandy. Sandy was processing 130,000 Rand worth of depreciation, whereas from the group perspective, only 100,000 Rand should have been processed. So the difference each year will be 30,000 Rand in depreciation, which needs to be reversed. So because we are now 2 years away from that transaction, we are adjusting it for 2 years worth of depreciation. So it's debit accumulated depreciation plant 60,000, credit depreciation 30,000, and debit retained earnings 30,000. Okay, don't be mad, there's just one example left. Okay, so here we have an example C where we have sale from subsidiary to parent. So on the 1st of April 2011, Eddie acquired 100% of Sandy for 850,000 Rand, representing the fair value of the consideration transferred. On this date, Sandy had share capital of 500,000 Rand and retained income of 300,000 Rand. All the assets of Sandy Limited were fairly stated on acquisition date. On the 1st of April 2011, Sandy sells an item of plant to Eddie for 780,000 Rand. Okay, so here the sale is taking place from Sandy to Eddie, whereas in the previous example, Eddie sold an item of plant to Sandy, whereas here the subsidiary is selling to the parent. So this plant cost Sandy 1 million, was 4 years old, and had accumulated depreciation of 400,000 Rand at the date of sale. The remaining useful life of the plant is assessed as 6 years. Prepare the journal entries relating to the sale of the plant in the books of Sandy. Then we're going to prepare the journal entries relating to the sale of plant in the books of Eddie. Then we're going to prepare the necessary pro forma journal entries as at 31 March 2012. So in Sandy's books, Sandy is recording the sale. Sandy is saying debit 780,000 Rand, being the item that was paid, being the payment into its bank account for this plant. Then Sandy is debiting accumulated depreciation of 400,000 Rand. It is reversing this item in its books. It is crediting the cost of the plant being 1 million Rand. It is basically reversing the carrying amount of this plant out of its books. It is recorded profit on sale of plant of 180,000 Rand. So the sale of the plant is a gain of 180,000 Rand. So do you agree this will be shown in the books of Sandy? But in the group's books, this gain needs to be reversed because it has happened within the group. The cost and accumulated depreciation will also need to be reinstated. And then in the books of Eddie now bought this plant and they recorded it as 780,000 Rand. So Eddie is going debit plant 780,000 Rand, credit bank 780,000 Rand. Then Eddie will record depreciation based on the new useful life of 6 years. So debit depreciation 130,000 Rand, credit accumulated depreciation on plant of 130,000 Rand. Okay, so this is the journal entries in Eddie's books, and the previous slide showed the journal entries in Sandy's books. Let's have a look at the pro forma journal entries. So we need to debit profit on sale of plant. So there was the reversal of profit recorded in the books of Sandy and the reinstatement of accumulated depreciation. So previously Sandy recorded a profit on the sale of plant. Now we are reversing that in Sandy's books. We're also saying Sandy, pretend the sale never happened in the group books. So we're crediting accumulated depreciation of 400,000 Rand. So here we are pretending as if the sale never happened. And we're debiting plant of 220,000 Rand to bring the cost up to its original cost of R1 million. So the result of the above pro forma journal entry is that the gain is removed and the asset and the accumulated depreciation are restated to that reported by Sandy prior to the sale. So we're almost pretending that the sale never took place. So the analysis of owner's equity will be impacted. So we need to subtract the profit on sale from the profit for the year and add the accelerated depreciation back to profit in the analysis of the owner's equity account. So here in this situation, the analysis of owner's equity will be impacted because of the way in which the sale took place. The sale was from the subsidiary to the parent. So the analysis of owner's equity shows the analysis of the subsidiary's owner's equity. Okay. So that is the last slide. Before you run away, I was just told to tell you that the mock assessment that is open, it is going to open at 1 today. Okay, so I've just finished in time for that. Those that didn't do the mock assessment for test 1 must do the mock assessment now. If you did do the mock assessment, you can do it again still, but yeah, please do the mock test today. It is available at 1 o'clock, which is in 13 minutes. It's important that you test whether your UJ Invigilator app is working. Okay. Okay, so okay, so please, yeah, I'll send you the access code. Apparently the QR code has been sent, but there is a way you can type it as well. I'll just type the QR code here and then you guys can view it, but I'll also put it in an announcement, okay? So please do this mock assessment. Even if you did do it the first time, do it again. So the start code should be shown as 317DB7DE. Okay, this is what I have been told. If you are unable to access using the QR scanner, you should be able to type this code in. The mock assessment doesn't count, but it doesn't matter because the problem is if you don't do the mock assessment and you're not able to use your Invigilator app next week, Wednesday, it will say it's your own fault for not trying. Okay, so it doesn't count for marks. The aim is that you do it to assess whether you can use your UJ Invigilator app. Okay. Okay, guys, well, that is it from me. I'm going to stop the recording. It was a very long session, but it's just the work we had to get through. But I suggest you